In this video, I'm going to break down one of the easiest and most effective ways to invest in the stock market. That is buying an ETF. In this video, you're going to learn everything you need to know about ETFs and how to pick them so that you can start creating passive income and building wealth by investing. Hey, I'm Britt Baker, co-founder of Dow Janes and money coach. And if you want more helpful tips about investing, be sure to subscribe to our channel. It means a lot to us and you won't miss out. What are ETFs? You can think of ETFs like a basket of a bunch of different types of investments. Imagine a pizza with every topping. Instead of having to choose between pepperoni and mushrooms or pesto or red sauce, you get all of it on one pizza. That's how you can think of an ETF. So ETF stands for Exchange Traded Fund, but that doesn't really mean anything unless you understand how investments are traded. And frankly, it's not that important when you're just getting started investing. But just so you know, ETFs, because they are traded on an exchange, can be bought and sold multiple times per day. Mutual funds, on the other hand, while they are also a basket of a bunch of different types of investments, like that multicolored pizza, are only traded once a day. So mutual funds are less liquid than ETFs. Again, for the average investor, that doesn't really matter, but now you know. Okay, so let's get into the stuff that actually matters, starting with the advantages of ETFs. ETFs are a great investment option for a few reasons. First, and most importantly, they provide automatic diversification for your investment portfolio. When you invest in an ETF, you are instantly investing in hundreds, sometimes even thousands, of stocks at once. And depending on the ETF you choose, those stocks will likely represent a wide variety of industries. Now, I'm saying stocks here, but you can also get a bond ETF. I'm just using stocks, for example. So why does that matter? Why does that diversification matter? Think of it this way. If you were going to go on vacation for a week and you didn't have the weather app, you might not know what to pack. So to prepare, you bring some lighter clothes in case it's warm, a jacket in case it's cold. Maybe you bring sunglasses and rain gear. Since you don't know what to expect, you prepare for a variety of circumstances so you can enjoy your getaway, rain or shine. The same principle applies to investing. It's risky to put all your investments in one industry, one geography, or one company. If that industry, region, or company underperforms or drops, then you could lose a lot of money. But if you spread your money across a variety of investments, you're much less likely to see a total drop in value. And ideally, you'll have much steadier, consistent returns. For this reason, when it comes to investing, diversification is key. And investing in ETFs gives you instant diversification. As I said, a single ETF can encapsulate hundreds or thousands of stocks across various industries. Of course, there are also ETFs that have stocks from a particular industry or sector. Some ETFs only hold US stocks, while others hold international stocks. And then, of course, there are ETFs that just have bonds. We'll talk about all of that next. But essentially, there's such variety among ETFs that choosing a handful of ETFs rather than a handful of stocks is an easy way to instantly diversify your portfolio. Finally, the added benefit of ETFs is that they have relatively low costs. Because they can be traded like stocks, you can typically buy them with the same low commission or even no commission depending on your brokerage. They also tend to have low expense ratios, also known as fees, which I'll dive into more a little later in this video. So let's talk about the different types of ETFs that exist. There are currently more than 2,000 ETFs listed on US exchanges with combined assets exceeding $5.8 trillion. With so many options, you may be wondering, how can you pick one that's right for you? Well, I'm going to tell you in a second, and I'm going to give you a list of some great beginner-friendly options. But the first thing you need to understand when it comes to ETFs is what type of assets are in the fund. Now, when I say fund, it's just another word for ETF. Exchange traded fund, just fund. So ETF and fund, they're synonymous. And what you want to know is what are the assets that are in the fund or in the ETF? So is it a stock fund? Is it a bond fund? Is it a REIT fund? Or is it a commodities fund? If this is new language to you, check out our video on investing in stocks for beginners, where we cover all of that. So when you're creating your portfolio, your asset allocation, what percentage of your portfolio is made up of stocks versus bonds, is the most important decision to make. It determines your overall risk and your overall potential for returns. Bottom line, if you're young and you have a long time horizon to keep your money invested, or if you have a higher risk tolerance, You generally want to be invested heavily in stocks. Think 80 to 90% stocks in your portfolio. If you're closer to retirement and you know you'll need to take your money out of your investments in 5 to 10 years, or if you're a more conservative investor, then you'd want to have a ratio closer to 65% stocks, 35% bonds. The actual percentage is totally up to you. Those are just guidelines. So once you know your desired asset allocation of what percentage you want to be stocks and bonds in your portfolio, then you can start looking for specific ETFs to fill it. And when you're looking at ETFs, there are two things you want to pay attention to. One, is it a passive or an active ETF? So passive ETFs follow a specific sector of the market, such as the S&P 500 index, which tracks the 500 largest companies on the US stock market. It's updated periodically, usually quarterly, to ensure that it's following its segment of the market. But it doesn't require hands-on management, which makes it a popular choice. Active ETFs are a little different. So active ETF managers track the direction of the market and trade accordingly. They can take advantage of short-term movements. For instance, if the S&P skyrockets soon after the market opens, traders can lock in profits. So the difference there between active and passive is passive means it's set to, usually to an index, whereas active means there are people in there making decisions about what the ETF is invested in. You might think that there's a benefit to having a person who's choosing it with the active side, but just remember that it's actually extremely difficult to beat the market. A small number of actively managed portfolios actually have an edge over passive ETFs, and you pay for them to actively manage the fund. So you want to do your research and see if it's worth it. If it were me, I would look for passive ETFs over active ETFs any day. The next thing you want to look at when you're evaluating ETFs is the expense ratio. Now, the expense ratio will likely be correlated with whether or not it's an active or a passive ETF, but let's get into it anyway. So first of all, what is an expense ratio? It is the fee charged by your brokerage to invest in an ETF. They're often listed as an annual percentage. So for example, if you see an ETF with an expense ratio of 1%, then for every $1,000 you invest, you pay a $10 fee. Most ETFs will have very low expense ratios, usually less than 0.1%. But just pay attention. Active ETFs will likely have higher fees than passive ETFs since they're being actively managed. Okay, now let's talk about the pros and cons of ETFs. While there are a lot of upsides to investing in ETFs, which I'll explain, I'll also get into the downsides. So one of the upsides, which we've talked about on this video already, is the instant portfolio diversification they provide. Rather than having to pick a handful of different stocks, different companies, different regions, industries, sectors, you get all of that by choosing one ETF. And then you can create your own diversification by choosing different types of ETFs, meaning a stock ETF, maybe a US stock ETF, an international stock ETF, and a bond ETF to create your portfolio. Second benefit of ETFs is that it takes the guesswork out of investing. Instead of trying to pick the best stocks or predict market fluctuations, ETFs tend to match the market performance. Another advantage is that they're easier to buy and sell than mutual funds for the reason we talked about earlier. And while investing in individual stocks or bonds is complicated and stressful, ETFs are simple and they don't require hands-on management. So those are the upsides. But let's talk about some of the downsides to investing in ETFs that you should be aware of. One is that you have no control over what is in the ETF. That might mean that you end up being invested in tobacco companies or gun manufacturers, and those might not be aligned with your values. And although they are low cost, because they're managed, there is still a fee, unlike individual stocks. But granted, the diversification that you get access to is worth the fee from my perspective. So now that we're here and you're super on board with wanting to invest in an ETF, let's talk about how to actually start investing in ETFs. What are the steps that you'd actually take? 1, you open a brokerage account. Before you can start investing, you have to have a brokerage account to buy, trade, and sell. So this is similar to a bank account, but instead of having it be at a bank, it's at a brokerage. Examples of brokerages in the US are Vanguard, Fidelity, and Charles Schwab. There are others. And if you're not sure what brokerage to go with, we do have a full video discussing the pros and cons of different brokerages, which I'll link to in the description. My personal favorite is Vanguard, but that's not investment advice. It's just where I choose to invest. The next thing you're going to do is choose your ETFs. And if you're new to the world of ETFs, you might want to look at passive index funds. They don't require hands-on management, their fees are lower, and like I managed earlier, active managed, the alternative, ETFs rarely outperform passive anyway. When you're choosing ETFs, you want to think about getting a variety of different ETFs to create your overall portfolio based on your time horizon and risk tolerance. This is the same concept we talked about earlier with asset allocation. It's picking the percentage of bonds and the percentage of stocks you want in your portfolio based on, again, your age and how risky you are. So here's an example. If you're under 30 and you are investing for retirement, meaning that money has potentially 30 to 50 years to grow, you might consider putting 100% of your portfolio in a US equity ETF. On the other hand, if you're 50 and hoping to retire at 65, you might want to put 65% of your money in an equity ETF and 35% in a bond ETF. Again, the reasons for that, I won't get into in this video, but we do talk about it in our other video on introduction to the stock market. So you might be wondering, how do I find an ETF? What does it look like? What are they called? I'm going to put some examples on the screen of some ETF names and what you might look for. So these are an assortment of ETFs. Some of them track large US companies, other track smaller US companies, some are international, some are emerging markets. As you can see, there's a huge variety of ETFs that exist, so you really get to pick exactly what you want in your portfolio. When it says REIT, that's a real estate investment trust. Bonds, those are bonds, as we've talked about. You can have international bonds, you can have US bonds, and then you can have things that track specific indexes like the S&P 500 or the NASDAQ. The NASDAQ index has mostly growth and tech stocks in it. So that's an assortment of ETFs. This is just a handful of the thousands that exist. As you're creating your portfolio, you'll want to pick a handful of ETFs, again, that match the right asset allocation for you based on your time horizon. Then you buy them, you put them in your portfolio, and you sit back and let your ETFs get to work for you. All that's left to do is let your money grow while you work, sleep, eat, or walk the dog. You can check in on your investments every quarter, but try to avoid looking at them more than that, as the fluctuations in the market could drive you crazy. All right, if you've gotten to this point, congratulations. You've successfully completed your crash course in ETFs. You are now ready to start building wealth through passive investing. If you want to learn more about how to be a successful wealth building investor, be sure to check out our free masterclass. In it, we break down our simple 3-step system that thousands of women have used to start living with financial freedom, take control of their money, and build wealth. Thanks again for watching. Don't forget to subscribe and like this video, and I'll see you in the next one.